Welcome to I'm Your Target Demographic. Today we're going to outline something called a credit score, which is really focused on the United States, but other countries likely have something similar to help mitigate the risk of lending money to someone or giving them credit. If you're getting a credit card or buying a house, the person on the other end needs to know that you can make payments. So there's a process to look at your history and give you a numerical score. Your score also determines the interest, which is a percentage that you'll have to pay extra in order to get that loan. The higher the interest, the more money you'll pay beyond what you're actually owing. The idea of a credit score as we know it is fairly new, with these scores really originating in the late 1980s. Before that, it was up to the lender to make that call, and there's a lot of discrimination at play, basing these decisions on factors that weren't really applicable. In 1974, we saw the passing of the Equal Credit Opportunity Act, so someone could not be denied credit based on things like gender, race, marital status, and more. So a system was created to assign this score in an ideally unbiased way that would apply across the board, a score that could tell a possible lender what they needed to know. You're not born with a credit score. You usually need to open an account first, something like a credit card. After 3 to 6 months, you'll likely be able to retrieve your score. See, this lender reports information to what are called credit bureaus, which are essentially databases that track where you have accounts, your payment history, who is wanting to know your credit, and more. It's these bureaus that ultimately report back and help decide your credit score. To get your credit score, the largest 3 credit bureaus, called Experian, Equifax, and TransUnion, report back your information and weigh them against a lot of factors, which we'll touch on in a second. There's a few different strategies for creating this number. So you might see some references to a FICO score, or something called a Vantage score, which take the same data provided to them but manipulate and analyze that data in different ways. For some odd reason, these 2 main versions of your credit score start at 300 and max out at 850. If you know your score, let's look at what these scores mean. Since there's varying methods to create a score, and the bureaus may have different information, here's what the scores typically mean. In the 300 to 579 range, your score is poor. A bit higher, from 580 to 669, is considered fair. We then jump to good, from 670 to 739, and very good, from 740 to 799. Lastly, 800 to 850 is considered excellent. The better the score, the more you'll be approved for credit, and the lower you might have to pay in interest, since it's not a huge risk to lend you money. Now that we've established that your score is a snapshot of your likelihood to make payments back, what determines that? What factors into your credit score? The most important factor determining this number is your payment history, accounting for about 35% of what makes up your credit score. Whether you've only had credit for 6 months or for 20 years, how often are you making payments on time? If you've shown that you're reliable and making at least minimum required payments, you're less of a risk. About 30% of your score is tied to how much debt you owe. If you have 3 cards and you're making minimum payments, that's great, but it doesn't look great if your cards are all maxed out. Loans you have, including student loans, home loans, auto loans, all factor into this as well. Those 2 factors contribute the most, so the best advice to improve your score is to make payments on time and try to put a dent in the amount total that you owe. You might think that having no balance would be best, 3 cards paid off completely. That actually might lower your score as well. Not making monthly payments doesn't show the same kind of reliability, at least in the eyes of these credit bureaus. So keeping a low and manageable balance on each is key. The next category of what determines your score is your length of credit history, counting for about 15%. Having a card for 6 months is great, but it shows much more if you've had a credit card for 20 years and consistently made on-time payments. So your older accounts mean more. If you pay off your home, car, or student loan, you might not see an increase in your credit score because those accounts are likely pretty old. Closing those accounts lessens the amount of accounts you have in total, so it potentially hurts your score. It's not always intuitive on how all these factor into your score. At about 10%, it matters about the type of credit you're using. They want to see a diversity of types to prove that you're reliable in different ways. For example, you've got an installment plan to pay off a car. That is a set amount, versus a credit card that might have fluctuating costs from month to month, and that card doesn't end if you pay off your balance. The last 10% is how often people are checking your credit, or if you're applying for new credit, doing what are called hard inquiries. What they're trying to see is if you're applying for 10 different credit cards over the span of a week, maybe you're at a higher risk of making those payments. Luckily, they tend to bundle some things together. So if you're getting comparisons for a car and you go to several places, it'll likely only count as one hard inquiry of that type. If you see something show up on your report called a soft inquiry, it means that someone's checking your credit, but it won't impact your credit score because you're not actually applying for additional credit. Now, these categories are likely the same for everyone, but you might see the percentages differently based on what you're trying to borrow or how long you've had credit. This is just a typical outline for most situations, but it isn't black and white across the board. So if you're young and getting your first credit score, hopefully this helped you understand how to get and then maintain a positive score. Focus on payments, not having a huge balance on your accounts, keeping the older accounts you have, trying to get a diversity of types of credit, and not applying for a lot of credit all at once. Hopefully you found this interesting, and make sure to subscribe for a wide variety of educational videos. Thanks for watching.